Hey guys, Freaky Finance here. It's been a little bit. I think the last video I did was Stone before Halloween. As you can see, the decor has changed. It's now approaching December and into Christmas. Under a month from now. Today is November 26, 2022. Today we're going to do a simple video. I did a longer video last week and I just didn't post it because it was more than an hour long and I did not want to edit it. So I'm going to try to keep it quicker today, and that way I'll be more motivated to edit it after I'm done. Alright, so let's get into it. So Jakks is a toy maker. It's a toy maker that basically sells, I want to say, 60% of its product between three channels. So specifically Walmart and Target, and then they have a bit to Amazon that fluctuates. Some quarters it's 10%, other quarters it's under 10%, so they don't have to break it out. But so that's kind of like the setup. Year to date, they've done quite well, which is one reason for the video. Another reason for the video is I like to do ones where I'm not currently up, so I can revisit them and hopefully it sells off more and I can add more. So I do own Jakks, and I just started a small position in it, and I'll probably add as it goes down. Opportunities tend to present themselves, even though lately everything's kind of gone up the last month anyway. They have these, basically they sign these IP. We'll go through the business overview in a second, but they sign this IP for certain brands that some of you guys will be familiar with. So Black & Decker, Creepy Crawlers, Disney, specifically the Encanto doll's been doing very well for them this year. And then you have Nintendo and Sonic the Hedgehog. In 2022, they had strong sales really out of Sonic and Encanto and a lot of the Disney princesses in general. Ultimately, with that, you pay a royalty to the IP owner. So this would be Disney's case for Encanto and all these dolls here. So that's why that image is there. Let's just see channel check. So when I type Jakks Pacific into Walmart on the Canadian website, it's kind of showing me all these Super Mario ones. So that's again the Nintendo partnership. And these are all products that I've associated with Jakks Pacific as the brand right on the website. That makes it easier for a channel check. It kind of shows you, like some people would just click on the shop at Jakks Pacific itself, and Jakks Pacific itself isn't that big of a retailer. Direct to consumer. It's definitely more of a supplier of the Walmarts and Targets of the world. Again, here's on Walmart or Amazon side. This is just what popped up when I typed in Jakks Pacific in Amazon. So we'll go hyper level first. So the sales have picked up. We'll see how consistent this is based on current sales and current EBITDA. This company is trading very cheap. And you can see the even Q3's EBITDA was almost $60 million in a single quarter. Now Q3 is their high quarter. So there's seasonality here. And Q4 has a hard comp against last year because Christmas sales were quite good last year, specifically for goods. And you can see the trailing 12-month EBITDA has just gone up and to the right. So the company is doing very well as of late. But importantly, you can see that it was weak down here. And so one of the things we have to wrestle with this investment is how consistent is the current performance. And that's the uncertainty. And I don't have a great angle on that one because really you're going from hit to hit, right? You're hoping for what's the next year's Encanto doll for these guys, right? What's the next year's Sonic? Maybe it's more the same, right? They already have good brands. So maybe it's just keep executing. One of the things I'd also say, just strategically, so when you do good at Walmart and your sales are going up, say, this is just the Walmart example because it's more than 25% of sales, but if you're doing well, you're going to get more shelf space, right? And the Walmart, and that's probably going to keep further momentum, right? And then all of a sudden, when you have a miss, you're going to start losing shelf space, right? So it's a sensitive relationship, and it kind of builds on itself. Like you're going to be hot right up until you're not. And I think, well, the reason why I'm starting a position is I'm hoping that there's some weakness in the year-over-year comps, and I can get a better price. But right now, I'm getting a pretty good price on the current EBITDA. But you have to remember that this isn't. We don't know what the sustainable level is for this company, right? Or if there is one, maybe that's just part of the nature. It's like a boom bust cycle. I already showed that I owned it. So I have a screener here, but I didn't post the video I did last week yet. But basically this thing is, don't just look at it and think these numbers are accurate here. These EV to EBITDA multiples. These are older numbers. And 2, this is not always the metric. And 3, these are all different industries, so this metric means different things at different times. So don't just look at this, but it's my screener just quickly to see, okay, what's going on. What things are currently very cheap, right? So most people would view anything under 10 as cheaper, but I like the ones that are really cheap. Now some of them are cheap for a reason. They're retailer and they're coming up against card comps and they're getting killed and they might go cheaper, right? So I'm trying to add as they go down. That's the idea. Ultimately, Reitman has worked out lately, but you can see Jakks Pacific is up there. And then yeah, screening under 2 times EBITDA, which is special, right? But again, you have that. I kind of talked about the main con, which is you don't really know how reliable the current EBITDA is, right? It seems to be hit driven, like what product is going to pop off the shelf. But current results, Q3, very good, right? Sales continue to increase, and importantly, international's picking up. And this is the best part for me, is the debt. So the debt's gone down $100 million over the last 7 quarters. And that's not net debt. They actually have $70 million in cash, so they're actually net debt positive. And the biggest weakness for these guys, aside from the cyclicality of or just hoping where your next product hit is going to come from, the main con is the capital structure. These guys, during the periods of stress, have had to finance at what I would call bad rates or bad terms, and usually a combination of both. The covenant list is annoying. Like I had to go through the annuals, and I was like, oh. So that's the biggest con here. And we'll go through that really quickly too. But I just wanted to get that out of the way first. I think that's the last good visual. And again, I already talked about sales are strong. And the sales are flowing through the scale in the P&L line. For EBITDA, so we talked about the business that relies on IP, multi-brand IP. You're kind of diversified in a brand IP way, but you'll see real torque in the performance when one product does very well or 2 products do very well. Anyway, these are just me highlighting some of the brands to get a feel for what's coming up, right? Because we do have the Super Mario Bros. Movie coming out. We do have Dungeons & Dragons movie coming out next year. And again, one of the things when I did the Cineplex thing is I know video production, movie production is going to kick up about 50% year over year, right? Just based on what the executives have said for their movie slates relative to 2022. So I'm hoping, if there's more movies coming out, maybe we get more traffic and more sales, right? But we'll see on the royalty model. So we'll see that when we go through the cost of goods sold, and then dominated by Walmart. So this is good and bad, right? So it's bad as a key risk, right? Key customer, if you lose it, your sales are going to get destroyed. But when you're performing, that key customer, that key relationship is going to give you more shelf space to keep selling more stuff, right? Right up until you're not selling anymore. So you kind of get this kind of momentum swing. So we talked about the major customer. We didn't talk about major jurisdiction, so it's still very much U.S. sales driven. These are annual numbers. And again, you can see here in 2021, they still didn't have to break out Amazon. But certain quarters, you can see Amazon sales. Like this is the Q3 one, the recent one. You can see that Amazon's on there again. Whenever a customer is over 10% of your sales, you're supposed to break it out on your quarterly and annuals in segment reporting. So anyway, you can see Amazon's the one that's all over the place. Walmart held its own, and Target has increased, but it's decreased as a percent of sales. Which is interesting because we also heard that on the calls of Walmart and Target, right? They're totally different. Walmart's doing very well on consumer staples, and it's actually getting shared because during periods when times are tough, people view Walmart as a value proposition. So they'll trade down to Walmart themselves, and then within Walmart, they'll also trade down to the Walmart private labels. But anyway, for this purposes, it's just interesting to look at it, right? Because you're really relying on these 3 channels, 3 companies. All right, let's do annual first. So the annual, I want to do the annual because you can see how unprofitable the company can be as well. This is the operating income one, is the more important one. You can see that right here. The general and admin expenses is quite high for the business. Now you can see it's fairly steady. Like the business did quite a bit more sales here than here, but you can see G&A expense is actually flat, right? So the last 2021 actually looked good in terms of expense management relative to revenue growth, and this trend improved in 2022. But again, I want to highlight here, this sort of was where the 2019 was bad, right? So, and the share price reacted to bad, and it had a rough, I'd say 2017 to 2020, and it's had to, in order to finance losses and stay alive, I think it's had to take terms that were not in the best interest of shareholders. But now, with the debt getting better and the cash flow coming in quite high at a pretty fast rate. The business is improving that capital structure side, which is a big de-risk in my eyes for me. But you can see the hit or miss, right? If you got a hot product, you're going to start seeing the torque in the operating income, and this trend continued. I think this is for the entire 2021 year, but I just like when we go through the Q3 for 2022, they did more than this in one quarter, right? So there's a lot of torque on the operating income when they have some hot products. Really, I break it out two segment: toys and costumes. Costume seems to be more volatile than toys. What else is there? The share price has gone up lately, but it was dirt cheap for a while. Again, one of the things that's kind of misleading when you see a share price double, you're like, oh, that's a big deal, right? Right, it is. It's $100 million more expensive, right? But you got to remember the debt went down $100 million. So the total equity value or the EV of the company is actually not increased as much as the operating fundamentals would suggest it should. That's what I'm trying to say. It appreciated, but it's not reflecting the current fundamentals, partially because they've paid down so much debt with the cash flow. You can see what I'm just looking at here is royalty as a percent of revenue, selling percent of revenue, and then their overall operating margin. You can see the torque when they got something hot going on. Quarterly, we'll go into more time. What are we at? 13 minutes. I'll try to be quicker. You can see just a pretty blowout quarter in Q3 in sales. Again, you have the dolls that are selling for them. I think that's especially on the Disney side, and we see that a little bit more with royalties pick up as a percent, but again, you're getting quite a bit of scale on these sales over your G&A expense, right? When you can get up that much more in sales, but we have to incur. Yeah, technically, if I add these two, you're at 37.5 million. I add these two, you're at 37.7 million. So with that much more sales, you pretty much didn't increase these two lines when summed together year over year, which is impressive, right? And we see that here in operating income go up 17 million. Again, for a company this size, this is a small company. That's impressive. They do have this preferred share. We'll talk about that in a second. They had to keep marking it up as the common shares keep increasing, or at least that's my understanding. That one I think is only 6%, so at least it's not. They have a floating rate on their term loan right now, which is I think it's floating around 10%. So they're definitely incentivized to keep the cash flow, to keep deleveraging the business. So really on the P&L side, it looks really good. I mean, the only negative is taxes are going up because they're more profitable. So share price is also another negative because it's gone up year over year, right? That's always, I know it's sometimes counterintuitive for people, but it's always bad in my eyes. I like things when they get cheaper, right? We are seeing some dilution. That's been pretty steady. They did a reverse split. They also, the convertible notes converted. That was on the end. We should have brought that up, but you can see that the dilution is real. But again, some of that dilution was to lower the debt, but it was dilutive, especially at the share price that it was at the time of dilution. It definitely favored this director of the company more than the common shareholders, in my opinion, especially because that debt interest was so low. But at least that overhang is now gone for me to do this video. But anyway, you can see the assets, 76 million in cash, up from 44 million year over year. So they're starting to get more cash, and that's what's working capital against them. They have more AR, more in inventory. Inventory is not up as much as I thought it would be for a retailer at this time. They're actually doing okay on the inventory management. When we go here, trademarks are small for the business because again, they just license other people's IP. So they're not actually making acquisitions and bulking up, which is good. You can see that total indebtedness continued to go down year over year, right? So it was like, what, 160 or something, then down to 95, now down to 70. And the accumulated deficit, so this company does have accumulated deficit, which means it has a history of making losses on retained earnings, but it's working it off pretty quickly here. What else? You can see that free cash flow is pretty special in 9 months, right? You're at 67 million in 9 months. This is a company that's only currently worth $200 million, right? And that's just 9 months. So if I analyze that, you're almost getting something, yeah, right here. It's under 3 times cash flow based on current year. So it is cheap, right? But the thing is, you don't know what next year is going to be. But if they keep this up a few more, even one more year, it'll be special. The capex is fairly low for the business. It's not very capital intensive. There is some depreciation of tools and stuff like that. amortization of tools up here. The depreciation expense itself is quite low, so most of the earnings and turns into CFO, turns into free cash flow. There's not too much to be reinvested back in the business, which is good because it's helping this debt pay down quicker. So the bad margins, so margins now, it looks 28 is worse than 31, but they're still doing well relative to their old range. One of the things that's been happening with these retailers in general is, probably most of you are aware, shipping rates were high last year. They've come down now, but I don't know how familiar you guys are, but with the accounting for inventory, so with landed costs, so when you bring things in and you have all this extra cost for freight and stuff, you want to make margin on it. A lot of companies, they'll add it for cost of goods sold. So say if it costs $25 to make and $5 to ship it, they'll have it on their books at $30 inventory worth, and then when they sell it, that's when it turns into cost of goods sold. So the inventory on the books still needs to, the higher inventory on the books from freight expenses needs to work its way through the income statement still. So we're going to see some more pressure, even though we're seeing shipping rates go down. That will be on a lag. Like, we'll see the benefit of that next year. Not this quarter, not the Q4 quarter, and probably not the first quarter of 2023. I would imagine it'll probably be a back half thing. Royalty expense is also higher. That kind of tells me that they're relying more on the IP of certain brands, more than their own brands if they have any. It seems that their strategy is more to partnership with people that have the marks, trademarks. Selling percent of revenue is the main source of scale, and so is G&A, even though I think that level is higher than it needs to be. What else is there? Operating income, you can see, is almost 50% better year over year. The EV looks up like it's high, but again, that doesn't even take into account the cash position. So if I were to just subtract 76 million from here, right, 183, so yeah, 2 times free cash flow. This is a little bit misleading because it's just annualizing this current quarter, which is like the peak quarter of the year for them, and it's the peak quarter they've had for a very long time. So it's not this cheap, but it is around this cheap, which is pretty cheap, right? Margins are expanding, so it is scaling. This is an interesting relationship. They actually had more out of their main 3 channels last year than they did this year. So what I'm thinking is, could see better opportunity if Christmas sales are weak. A lot of people have talked about pressure on the consumer that should impact goods. It's hard to. We'll see. Basically, we'll see how strong the brand is and the product offering really this Christmas. What could also happen is they put a at the market offering to issue more shares, and if the share price, like it has, it's responded nicely lately. What they could do is issue shares, dilute to current shareholders, and pay down more debt quicker. Now, they shouldn't need to with their current cash flow and their cash on hand, but that's something that could happen, which would also probably give me a better entry. So those are kind of what I'm hoping happens, right? It goes down, I can buy some cheaper. Ultimately, the biggest risk here is, even though it's at 2 times free cash flow, is that I don't know what the next years are going to be, right? It really relies on getting hot products on the shelves of Walmart and Target. That being said, I think with all the movies slate next year for so many different things, I think it's going to help them. Dilution, I think, I talked about, well, I didn't show the numbers, but you can see there's quite a bit of dilution that happened in 2020 and 2021, specifically with a director that gave them money for convertibles. They actually converted, and they converted at a very low price, relatively low price. So that sucks in terms of dilution, right? They got $15 million for 2 million of shares that they had to issue, but now, I mean, those shares are worth 36 million. I mean, in hindsight, they didn't know the share price was going to go up as much as it did, but perhaps this director did, because it definitely worked out in his favor, right? So you can see during periods of stress, this company has to take on certain debt instruments that may not be in the best interest of the common shareholders. So that's another risk. That's currently the opposite's happening now. They're actually bettering the capital structure each and every quarter. And I hope that continues. The debt, so they have started to pay it down with their cash flow. So in June, they paid down 10 million voluntary free, and then in September they paid 17.5 million down with a 500k penalty for prepayment. This makes sense to me. Here you can see the rate, LIBOR plus 6.5 to 7. So this is their current debt that they have remaining. So it makes sense that they're trying to pay it down as quick as they can with their cash flow. This is what I would be doing, especially when your debt's that high. right? And your cash flow's coming in so strong. That's the biggest risk, right? It's hard to, the old saying, it's hard to go bankrupt without any debt. So the quicker they get this debt off, the better. Especially because of the uncertainty of future sales, right? The preferred, yeah, that's the 6% one. You can see the convertibles are no longer on the balance sheet because they've all converted. So the dilution's already happened on the converted side. So there's no more left there, but there is the preferred that's slowly going up. They have to keep marking this up in value, which is hurting the earnings as they mark it up in value. It's going up in value because the common shares are going up in value, or at least that's my understanding. They also do reverse stock split. This kind of sets the stage for how this business could be viewed as risky, right? Because when no one wants to give them money, they have to keep afloat somehow. So they actually did a reverse stock split just to keep compliance on the NASDAQ, so they could keep the equity markets open for financing for them. It kind of tells you that they don't have that much, like no one stepped in ahead of time to give them money. At least, or when they do, they step in their own self-interest more than the common shareholders. That's what I would say. So that's the biggest weakness in my eyes, which is now getting mitigated with cash flow. That's the trend again. This is the other con, is the uncertainty of sales, right? So some years you had 810 million. You haven't hit 810 million for a very long time, right? Last year was 621. I mean, the last quarter was pretty strong, but like really strong, right? 322, 220. So pretty strong lately. But you can see that it's all over the place. And the earnings power is also all over the place. And therefore the share price is all over the place. So if you're going back a bit, it looks like, well, we kind of missed the move, right? It's already gone from 5 to 18. But again, the fundamentals have more than technically 3x because you have to subtract the debt that they paid down all this time, right? The equity value has gone up 100 million, but the debt's gone down 100 million. But in the bigger context of things, you can see this company's been getting hooped, right? From 2017 really till now. Like this company with the reverse stock split, you can see it's almost over 100. So there could be a lot of room to run on this one if they continue to execute, continue to clean up the capital structure of the business with the cash flow that they're currently generating from their current sales. What else going on? For the read through October, they said October's sales were still good. So that's just the channel check there. Gross margin, I kind of talked about this, but higher costs with importation delivery, particularly early in the year, ultimately exceeded any price increases that we slipped through. This is them talking about the film slate for next year and all the stuff that's coming out, right? Little Mermaid. I think you have Sega coming up. And then you have Mario Bros. Movie coming out. Hasbro's Dungeons & Dragons coming out. So you have quite a few drivers of things that could be hits. Right? We don't know if they're actually going to have the same type of sales they just put up this year, right? They would argue that they would, but I don't know that. And then the shipped, so this is the shipping part, right? It has come back down, but it will take time for that to show up in the numbers, as they still have to sell through the inventory at these higher rates that they've had. So that will be favorable, right? That's why I'm thinking this could be a back half 2023 play. It could be a now, like I'm in it now for a small position, but I'm really hoping that something happens and I get a really good price. Because it already is a good price, so that's what I'm wrestling with in my head. International is doing well, and I'm looking to make sure that trend continues because that could be another driver because it so far is very dependent on US, and if they can keep expanding internationally like they have, it could get exciting in terms of growth rate. And then this one, so this is one of the reasons why I'm hesitant as well, is that their guidance year over year, so in their report Q4, their sales are going to look like they're down year over year. I think that's accurate. And then I can get a better entry as well, right? Because we'll see how the market reacts to year over year hard comps, and then maybe I can get a better entry there. That's what I'm thinking. I kind of went a little bit quicker than I wanted to, but I'm trying to keep these videos shorter for you guys and for me when I listen to them. Anyway, it is pretty cheap. Technically, it's the third cheapest thing on my list of cheap things. But yeah, that's Jakks Pacific. It's a interesting business. It's fairly simple to understand. So hopefully you guys enjoy the video and have a great rest of your weekend.